Wholesale prices in March came in better than analyst expectations, but it's not stopping investor concerns over the sticky inflation that we saw in Wednesday's CPI report. Taking a look at the major averages an hour and a half into the trading day, we're mixed right now. The Dow is off by about 200 points, 0.5% there, and declines. S&P 500 down by about 5.6 points. We'll round that off too. And then the NASDAQ Composite still holding on to some gains right now. So as prices continue to pinch the wallets of Americans, what could be a good way to protect your finances? Joining me now to discuss is Mike Remak, who is the head of investments of Citi Global Wealth at Work. Great to have you here in studio with us, Mike.
Great to be here, Brad.
Certainly. You know, as we're digesting all of this economic data that comes through and gearing up for an earnings season that could prove to be volatile depending upon what companies have to say about the current economic environment and demand trends that they're seeing, a lot of people are trying to figure out how to diversify their wealth and how to safely navigate the equity market as well. What are you telling clients right now?
Yeah, absolutely. I think on a week like this with so much economic data coming out, it's important to take a step back and really think about what it means as an investor. And the backdrop is really one of economic growth. So even the Federal Reserve last week with comments, they expect economic growth to continue through 2026. And you look at this inflation picture and, we've really seen inflation come down from about 9% down here into the CPI report from yesterday, which is in the mid threes. Now, it spooked investors that the print came in a little bit hot, but I think it's also important to point out that there are different measures of inflation. And the Fed even looks at a measure called the PCE, which will come out later this month. And, that PCE indicator could show that inflation has come down even more. Bottom line is our view is that we expect inflation to trend down into the 2.5% range by the end of this year. And that's a pretty good picture when you combine that with a healthy jobs market. We think it's still going to give the Fed some room to cut rates before the end of the year.
With the view that inflation will continue to trend down then, and other people trying to figure out how they position their portfolio accurately for it, what is the best portfolio positioning with that trend?
Well, the nice thing about this backdrop that I just described is that the cost of being diversified has gone down quite a bit. So as an investor, of course, your asset allocation is the primary driver of your returns. Getting that right is important. But this is a very, very different market than we saw a couple years ago. A couple of the key factors would be, one, a big reset for financial markets in 2022, one of the worst markets in history for a diversified portfolio. We saw the stock market, come down considerably, and bonds, of course, got crushed on the back of rising interest rates. You look at where we are today, you've got a bond market that is very attractive, that pays investors very well for relatively low risk, and there are opportunities across the fixed income continuum. In equities, last year was really about the Mag 7 and this rally in tech. And so if you look kind of under the hood of the equity market, still a broad swath of stocks that remain at relatively low levels with opportunity for a broadening out.
Some of the risks that still remain present. I mean, it's a massive election year just across the world right now. You think about the number of people that are going to be heading to polls in one way or another. Where and how do you rank some of, whether it be the geopolitical uncertainty, whether it be people going to elections and what the outcomes of those elections could be? How do you rank risks in this environment right now?
Yeah, look, the risks are always out there, and you've got known risks like the election, like this inflation picture and what that means for the Fed. And of course, the things that always tend to rock markets are the unknown risks.
Right.
And diversification is a great way to protect a portfolio from those short-term shocks. One of the things that I think about is that the U.S. stock market 15 years ago was 50% of global GDP. Today, it's 70%. Now, we don't think that the U.S. stock market is going to go to 90% of world GDP in the next 15 years. And what that really means is, it can pay to diversify a little bit outside of the U.S., to not have such a U.S. focus. But we do think that it will be important for investors not to get too sucked into the headlines around politics and policy, understanding that this is a pretty good economy where there's still a lot of value in the market.
To what extent does diversification mean taking a risk assessment and looking at some assets that people might not have previously tapped in. And naturally, people's minds might go to things like cryptocurrency or whatnot because of the new SEC, making sure the new SEC allowances of new crypto ETFs and whatnot. How much of that risk assessment is being done by your clients and saying, yeah, this looks like a risky asset right now, but what type of exposure should I be adding on?
I think it's a great question. I mean, we have a saying where I work, it's more core, and it's really about the idea that you want to have a core diversified portfolio, that's really where you're going to build your lasting wealth over time, getting that asset allocation right. Look, many investors are going to want to play at the margins, take some opportunistic bets, maybe at the outside 10% of their overall portfolio. But we would caution against going too heavily into some of those speculative trades.
Mike, great to have you here in studio with us. Thanks for kicking off the show.
Thanks for having me.
Absolutely. It's Mike Remak, who is the Citi Global Wealth at Work Head of Investments here on Wealth on Yahoo Finance.